I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Thursday morning. McGraw-Hill ringing the bell at the New York Stock Exchange on its IPO day. The company raising $414 million in that IPO. Tron getting things popping over at the NASDAQ. Ultimately, sorry, trade deal tracker friends, you'll have to take a backseat to a big morning for earnings analysis. Tesla is the top trending ticker on Yahoo Finance as the EV maker delivered the weak quarter everyone on the street expected. What they didn't expect was a subdued Elon Musk on the earnings call. Little less sizzle on the mic this go around for the prickly gazillionaire. Then we have Alphabet, which dropped the mic in its own right, but for positive reasons. Bullish earnings call commentary on cloud demand and how it's monetizing AI in its core search business. And then we have reports out there in the periphery in focus, such as IBM and Chipotle. IBM had a good quarter, and the stock is getting hit. Chipotle had an unsavory quarter, and that stock is getting shredded, just like the pork that comes out of that place. So lots on the analytical docket. Now, of course, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money in your portfolio. I know you have it, and I know it's there. Let's head down to the NASDAQ in Times Square and check it with Yahoo Finance senior reporter Ali Canal. Ali, I was just mentioning Chipotle, big swing and miss by them in the quarter. Squishy conference call. What are the restaurant stocks doing here this morning off of that report?
Not that well, Brian. We're seeing Chipotle shares opening down 13%. And as you were saying, this comes after that disappointing earnings report. The company reported a larger than expected drop in same-store sales and traffic, prompting a cut to its full-year outlook. And we're seeing those declines extend across the fast food casual space. McDonald's is down around 0.8%. Starbucks is down over 1%. We know Starbucks has had its own struggles in China. Yum, which is the parent company of KFC, Taco Bell, Pizza Hut down around 1%. So across the board here, we're just seeing weakness. And we've been discussing this bifurcated consumer economy, especially those lower income consumer, and that cohort of consumers are pulling back a little bit on their spending trends. And it's something that Chipotle executives have talked about in previous quarters, how they've seen that softness in demand. And at this point, it's really all about those discounts, those promotions. What are you doing to get customers back in the door? Because whatever Chipotle is doing right now, it's not helping things too much considering that foot traffic decline. So we're going to be tracking this throughout the trading day. And then just taking a look at some of the broader market action here. We have the Dow opening around 300 points lower. S&P 500 is in the green, up around 0.2%. And the NASDAQ, the biggest gainer of the morning so far, up roughly 0.3%. And that comes after Alphabet reported, and we're seeing those shares up, I believe, a little over 3% at the open here, Brian.
Ali, you have a fast food. Favorite fast food?
Do I have a favorite fast food?
Yeah.
I have to say I love McDonald's fries and a Diet Coke.
Fair enough. Burger King croissant which for me all the way. All right, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, in search of something bullish, Tesla supporters are looking for the next upside catalyst following a lackluster earnings call from Elon Musk. Musk voicing concern on the near-term outlook.
Will be some teething pains as you transition from a pre-autonomy to a post-autonomy world, but I think the future vision for Tesla is incredibly exciting and will profoundly change the world in a good way.
A tranquil Musk on that call. Number two, Alphabet setting the tone for large cap tech earnings. Tech giant ticked a lot of boxes with its latest earnings report. Revenue growth accelerated throughout the business. Cloud was strong, boding well for Amazon and Microsoft earnings due out next week. YouTube remained hot, and the core search business is being lifted by AI search functions. Number three, eyeing a few earnings letdowns. Like in life, nothing is perfect during an earnings season, even one that is going well, like this one. IBM shares under pressure after a real strong quarter. IBM CFO Jim Kavanaugh tells me the company is seeing huge growth in its AI backlog, though. Meanwhile, Chipotle is being spit out by the bulls on what looks to be a surprise slowdown in sales. Lots going on here this morning. Lots of earnings reports to dig into. Let's bring in my trusted roundtable for today. Troy Gayeski, FS Investments Chief Market Strategist, Lisa Schreiber, Radiant Investments Investment Analyst, and Ali Canal is still here with us at the NASDAQ. Troy, I want to get over to you here. A lot of interesting reports out. You had Alphabet, a good reporter, good quarter. IBM, good quarter, stock trading down. Where do you think the market should take its next cue from? Is it more of these trade deal headlines we're getting, or when a report like Alphabet comes out here and blows it away? Is that where investors should be looking at?
Yeah, Brian, before we get into that, just to correct you really quick, we're no longer FS Investments. We're now Future Standard.
Wow.
After our transformational combination with Portfolio Advisors, we wanted to meet the market with a unified brand.
Troy, I'm not surprised. I mean, you've been crushing it for decades, man. I've been following you. Good stuff, bro.
Yeah, good stuff. So just wanted to clarify that. But look, again, it's a bifurcated earnings season so far. I think clearly with Google's earnings, investors are getting more comfortable with the concept that, look, margins might not necessarily expand, even though they beat on the top line and the bottom line. And the investments in AI, which they increased significantly, are a required necessity to maintain the large moat around the hyperscaler businesses. So, I would focus more on the positive there. Mega cap tech in general, the NASDAQ is really the only listed equity index that's cheaper now, marginally cheaper than it was in 21, where the Russell and the S&P are materially higher. But then you do see the pockets of consumer weakness in areas like the lower end, as discussed before. So hopefully that addresses the question, Brian.
Good to see you, Troy. Lisa, over to you here. Alphabet, good results. IBM, good results. I mean, software up double digits for their quarter. Infrastructure business up double digits. What's your read-through to some of these reports that we're getting from a lot of competitors like Microsoft and Amazon coming over the next few weeks?
So I think especially when we look at Alphabet, which were the first ones of the Mag 7 names to report their earnings yesterday. And what we see here is that AI spend is going absolutely nowhere but up. So it's still very strong, which is a very perfect backdrop for the rest of the hyperscalers as they're coming in over the next couple of weeks. That benefits even more parts of the industries when we look at the rest of the value chain that needs to happen to make AI happen. So I think it's a very healthy backdrop. Alphabet crushed its earning, and that is also very important for the market overall, given the Mag 7 names have a weighting of about 30% of the market and are, again, driving the bus here.
Ali, yesterday you and I started the show talking about how Texas Instruments let everybody down, and that put pressure on a lot of those similar analog chip plays. But I look at what an Alphabet and what an IBM reported here this morning, and one of my read-throughs is, wow, that next quarter from NVIDIA, it's going to be huge. And maybe the market is right to send up NVIDIA well beyond a $4 trillion market cap.
Right, and if you have these hyperscalers aggressively spending, that's another company's revenue, right? And that feeds through into NVIDIA. So Alphabet shares, I mean, they are undervalued according to some on Wall Street. And after this earnings report, there's a lot of bullish optimism out there. Pivotal Research raising its price target on shares to $245 a share. And search results really stood out to me, especially since heading into this report, there have been a lot of discussions around artificial intelligence, whether or not that's going to bleed into some of the search impact for a company like Alphabet. But clearly we did not see that happen in the quarter. And also YouTube. This sticks out to me because I'm on these earnings calls for all these streaming companies, Netflix in particular, and they consistently cite YouTube as their biggest competition. YouTube is taking over more share of TV viewing time. It is the biggest non-premium audio and video platform in the entire world. So there's just a lot of strength in YouTube and a lot of different touch points for Alphabet as a company to really lean into. So start of the Mag 7, huge for this company and really huge for the broader tech sector as well.
Yeah, good call out on YouTube. I think my mom watches Yahoo Finance on YouTube there, Ali. So she's a very loyal fan. Lisa, let me get over to you back on Alphabet, though, because they came out and they raised their CapEx guidance by $10 billion. Now, if this guidance raise would have come 3 months ago, I would argue the stock would have been absolutely hammered. What are your thoughts on that guidance raise for CapEx from Alphabet? And should we expect more of this from Microsoft and even Meta, which is spending billions upon billions of dollars on AI?
Yeah, I think it's very positive to begin with. I mean, I think these companies have to spend at the moment to stay on the forefront of the AI build-out. And that's not only the AI, there is more the generative AI and the next part of AI. So they're all building on the future there. And I think it's a healthy backdrop. Again, it benefits a lot of different industries. And I think it's necessary for them to keep the edge here and keep on the forefront of the AI build-out.
Troy, some of these reports have me thinking, where is the economic slowdown because of tariffs? And tariffs, yes, they're out there, they're concerned, they raise the cost of doing business, but throughout this week, the earnings beats have been impressive. If you have beaten on earnings, your stock has been rewarded. You see Alphabet, like we were just talking about, raise their CapEx out guidance by $10 billion. Not a million, I mean, it's $10 billion. I mean, that has to be a good economic signal.
Yeah, no, 100%. I mean, we've been through this even at the dark days of Liberation Day, that when you have still a very strong consumer compared to history, admittedly in some metrics slightly weaker than 22, but in others like debt service or debt to personal incomes, personal income better, and you have one of the greatest investment trends we've ever seen, which is the build out of the AI infrastructure, which we're doing our best in market private equity to play for companies that provide power control systems to the hyperscalers and the data centers. You put those two together, it's very, very hard to have a recession. That being said, on the negative side, remember, you are seeing margin pressure in certain areas. Clearly, if you look at Japan or Europe, we're going to end up at a much higher tariff than prior to the beginning of 25. So in certain areas more dependent on, imported cost of goods sold, you'll have more margin pressure. But those that are locked in to the greatest investment trend we've seen in our lifetimes, it's just a question of how much more revenue growth you get. And to your point, $10 billion of additional spending is a huge number. Next year, approximately 45 basis points of GDP will be contributed by additional spending in the AI complex, which are numbers, that are just make your head spin in terms of size.
And even sales at Chipotle, disappointing in the second quarter. Those sales have come back in July. They said on the earnings call, so the consumer hanging in there. Lisa, I want to get over to you on Tesla. On the Tesla earnings call, Elon Musk hinted at master plan, his next master plan he's working on. Now, master plan number 2, if you go back there, dropped in 2023, April 5th, the day after my birthday. That's how I remembered it. Lots of talk about the green economy. I would think his next master plan will lean into robots and AI. How do you view Tesla here? Is it still a car maker first, or is it an AI play that should be put on the same pedestal as an NVIDIA?
Yeah, you just mentioned the great problem here with AI. When we look at valuation, investors also do not know exactly how to value it. Is it an EV maker? Is it more than that? I think we are in the transition phase, so it's a very critical phase for Tesla at the moment. The thing is, it's not anymore just an EV play, but it's also not a robotaxi robot company already. So we have struggles here, and especially with Teslas, we have to be a little bit careful. There's a lot of broken promises down the road, right? A lot of huge promises, but then delayed launches, and it doesn't really realize all that much. So I think we have to be a little bit careful here. And for us to being able to be a buyer here, we would need really some foot. We would need to see some foot on the ground, and we would need to see some realization first.
Ali, on the earnings call last night, I was looking for something that would hint to me earnings estimates have bottomed in Tesla for this year and next year. We've been tracking that a lot. You could track this on the Yahoo Finance platform. Just go to the Tesla ticker page, click analysis, and you can find these numbers. But they have continued to trend lower really over the past year. I didn't get that from this earnings call. It was unclear to me, has the auto business bottomed? Is Elon really going to truly go all in on robotaxis? Because if he is, this is going to be a very costly endeavor with an unproven top-line benefit.
Yeah, Tesla seems to be a company that's stuck between what it was, what it is, which is that pure EV play, and really what it wants to be, which is this AI powerhouse, leaning in on robots, autonomous driving. But that is definitely far out down the line, and we still have murky timelines there for when we could see these rollouts be more aggressive, and ultimately when that's going to be a profitable part of the business. The EV side of Tesla's business, that's the bread and butter. That's what makes the money, and we're seeing sales slow in the US. In Europe, there's a heck of a lot of competition on that front. So I get why investors are frustrated. And now with Trump's one big beautiful bill, that's going to be removing those EV tax credits. So that's going to weigh on demand for Tesla's business. That's also going to impact the energy side of the business because those solar tax credits are going to be removed. And that's something executives also talked about on the call. So there just seems to be a lot of hurdles here for a company that's looking way out into the future. Now, the Tesla bulls, they are still bullish, and they are banking on that future for Tesla, on the potential, on the possibility. But I wonder when the patience is going to start dissipating for investors. We've already sort of seen that, but there just needs to be a little bit more clarity on timelines, on profits, before we really start to see a rebound here in shares.
Ali, I wish you were back at Yahoo Finance HQ. Dan I is, of course, a Tesla bull, just walked into the office wearing his typical bright-colored hat and shirt. And the guy is just, he's just something else. Good chat here, guys. I appreciate you all. Thank you to my roundtable, Troy Gayeski, Lisa Schreiber, and our very own Ali Canal. Coming up, I'm talking to Keurig Dr Pepper CEO Tim Cofer, hot off the company's latest earnings call. The thing literally just ended, and Tim is here. Don't go anywhere. Welcome back to Opening Bid. We're seeing a big upside move in shares of software play ServiceNow. The company smashed earnings estimates last night and called out brisk demand for its new AI products. I talked with ServiceNow Chairman and CEO Bill McDermott about the drivers of the quarter. He explained AI adoptions by corporate America is proving to be a very, very large tailwind.
Jobs will absolutely change. I think one of the big things that people haven't tangled with yet is the idea that the 20th century org chart, just like the 20th century software industrial complex, is going to come apart. And it's going to consolidate on a platform like ServiceNow.
All right, for more on the ServiceNow quarter, head to yahoofinance.com. I wrote a story sharing some of my thoughts on the numbers. All right, for today's Opening Bid Power Play or interview, I have Keurig Dr Pepper CEO Tim Cofer. He is minutes removed from his earnings call. The beverage giant reported softness in its coffee business and reiterated its forward guidance. Let's dig into it with Tim. Tim, nice to see you here. Right off that earnings call, stock is reversing. You must have had a good conference call. I was stuck on set, so I imagine things went pretty well. Let's start on that the U.S. beverage business, up double digits in terms of sales. What is driving that growth?
Yeah, thanks, Brian. Good to be with you. You know, it was a good quarter, and overall, as a company, we delivered north of 7% sales growth and double-digit north of 11% EPS growth. So I think in today's, backdrop, we feel pretty good about that. I think to your question on U.S. refreshment beverage, this is our largest reported segment. This is a $10 billion business growing at double digits. And what you see underneath that is really two things. First of all, is a core base business that's really firing on all cylinders. And that's underscored by our carbonated soft drink business, our soda business, flagship Dr Pepper, throwing off another great quarter of growth, gaining market share. You're seeing market share gains for brands like 7-Up, Canada Dry. The other element is some of the newer additions to the portfolio, most notably energy. And last year made a big acquisition for Ghost Energy, really making a play in energy. Energy now for us is $1 billion business in net sales, growing high double digits, and feel great about that new move. Those are the two elements underpinning that strong double-digit refreshment beverage growth.
How sustainable are double-digit gains in that U.S. refreshment business?
You know, we feel good about what we've done front half and what we still will do year to go on U.S. refreshment beverage. I think that type of growth we can continue to put up over the next few quarters, underpinned by those two elements. Feel great about what we're doing in carbonated soft drinks, expect that momentum to continue. And I think things like energy, things like sports hydration with a brand like Electrolit. Electrolit, fastest growing scaled brand in sports hydration, grew at 30% in Q2. So we've got double-digit ambitions, at least for the next few quarters, on U.S. refreshment beverage.
We're going to talk a little bit about the coffee business in a sec, Tim, but there's such a different pace of growth between the U.S., the beverage business and the coffee business. And then you take a step outside of your business, you see what's happening at Kellogg and Big Food more broadly, businesses getting broken up. Have you considered that as a way to unlock the growth in a business like U.S. refreshments that is, it's significantly outpacing what you're doing in coffee?
Yeah, from a coffee standpoint, feel good about the sequential improvement we posted in Q2 relative to Q1. So you see the rate of both sales growth and operating income profit growth in Q2 sequentially improve. This year on coffee, the big feature is inflation. That input cost, that green coffee price is up significantly over prior year, and that's before you even overlay tariffs on top of that. And so inflation is the watch point on coffee, and that's why we've priced on that business, as has the industry. And we're also pulling other levers, as you'd imagine, mix management and productivity. To the second part of your question, look, we love our portfolio right now. We have a dawn to dusk portfolio of total beverage that covers basically every demand state, every need, anytime, anywhere we offer that beverage. And that gives us a lot of benefits in terms of scale from a procurement standpoint with our customers or our retail partners and consumer knowledge. So we continue to like the portfolio as it is. In the end, of course, I'm here to create shareholder value, and anytime there's an opportunity for shareholder value creation, you can expect management and our board will take a look at it.
You've been at this for a while, Tim. You've been in this industry for decades. Would a 50% tariff, as President Trump has proposed on Brazil, which is a main place where we import coffee, does that crush a business like Keurig?
Yeah, tariffs no doubt are a headwind for our business this year. I think we're navigating it well. Overall, when you look at KDP, you see a business that is overwhelmingly domestic based in terms of our manufacturing and our distribution here in the US, in Canada, and Mexico, in our primary locations. But we're not immune to these tariffs. We do source goods from outside the United States, and the notable example is the one you gave, which is green coffee. And, no tariff in the world is going to change the United States' ability to grow coffee. 99% of the coffee is grown outside the US. It's largely an equatorial crop across Latin America, Southeast Asia, and other countries. We have a sophisticated sourcing approach, but obviously these tariffs will provide incremental pressure as we go into the back half. And, we built that into our outlook. I think the tariff pressure will put some pressure on operating income and EPS in the back half. And yet, as I confirmed last hour on our earnings call, we do feel confident that we can still deliver an on-algorithm performance of mid-single digits in top line and high single digits EPS growth.
Tim, let me just follow up on that. And it's not only the beans that you use, of course, in your coffee, it's the Keurig brewers. In some cases, people have so many of these throughout their house. They've always been available at a pretty affordable price, but a lot of the components in there come from China and Southeast Asia. Is the reality that you have tariffs now on some of those components on brewers, you can have them even more on coffee beans? Is the value proposition for using a pod maker, does it go away because of these tariffs? And I imagine this is a big headache for your business this year.
Yeah, I think the value proposition will remain very compelling. Specifically to your comment on brewers, indeed, we source the majority of brewers from outside the U.S. We've actually done a great job post-COVID of reorienting our supply chain, and now a very small percentage, low single digit, comes from China, the balance in Southeast Asia. Here again, we therefore would not be immune to tariffs and the impact. We actually took a pricing round on brewers earlier this year. But when you look at that value equation that you referenced, Brian, and you think about the cup of coffee, a coffee shop quality level of coffee you can make from your favorite brands at home, it is still a fraction of the price point of that away from home coffee experience. And so that's the underlying value proposition that has caused our single serve coffee business with Keurig to grow so robustly over the last couple of decades. And we think will provide tailwinds going forward. And that's underscored by some of the brewer innovation, whether it's cold brewers, whether it's the latest one we're launching next month called K Crema, actually puts that fancy little layer of crema on any K-Cup pod. And then our next generation brewer that we're gearing up for late next year, which is incredible, highest quality espressos, cappuccinos, lattes. Importantly, all with plastic-free, aluminum-free pods. So we think we're going to be able to continue to innovate, bring coffee shop quality at a fraction of the away-from-home price.
Love me making some crema on my coffee at home. Tim, real quick before we let you go, I'm sure you have seen the week that your friends at Coca-Cola have had now come out with full sugar, or they teased that they're coming out with full sugar soda amid pressure from the Trump administration. Are you doing the same this year for Dr. Pepper and the other soda you sell?
A short answer, Brian, is yes. If you're looking for a real cane sugar Dr. Pepper, you can go buy that at the store today. We've had that variant for many years. In fact, just yesterday, Brian, I had one. It's delicious. And of course, we're here to serve our consumer. And so we've got a great portfolio from real cane sugar Dr. Pepper to a sweetener with corn syrup through to sugar-free variety, my favorite. Sugar-free, zero sugar Dr. Pepper grew over 30% in the second quarter. That's our fastest growing part of Dr. Pepper. That's another winner.
We'll have to leave it there. I should note, of course, I'm an avid C4 drinker. I love the beta-alanine in it. It just makes my skin crawl. In a good way, though, Tim. Keurig Dr. Pepper CEO Tim Cofer, good to see you. Thanks for hustling off your earnings call first. Talk to you soon.
Thanks.
All right, much more ahead on Yahoo Finance. Stick around.